good morning, Trinidad and Tobago, and welcome to the Bourse Report. But today we're taking a look at earnings once again, and the earnings results are coming in quite quickly now. And today we're focusing on the manufacturing sector broadly, and we're speaking today, of course, about WCO as well as Trinidad Cement Limited for their financial results for the 9-month period ended September 2030. Now, both companies would have experienced some reductions in revenues. However, they would have had very different outcomes in terms of changes in profitability, and we'll get straight into it. So looking firstly at WCO, and for that 9-month period ended 2020, earnings per share declined just around 4.8% to $1.19 from the $1.25 in the prior comparable period. Now, as mentioned, revenues did decline 6.2% from just over $700 million in the 9 months of 2019 to $659.3 million. Overall, operating profits did decline a marginal 4.4% from $451 million to $431 million. And our profit after tax declined overall from $315 to just around $301.7 million. So just some marginal declines, fairly commendable in the current situation of COVID and very lackluster economic growth. When we take a look at revenue and growth trends, well, this had after 2 very nice consecutive periods of positive revenue growth with 9.6% growth in the 9 months of 2018 and 2.1% in 2019. We see that slip in terms of revenues, down 6.2% to $659 million. However, WCO continues to be a model of efficiency. In fact, they continue to improve their efficiency. When we take a look at operating profit margins, we can see marginal growth over the past 4 consecutive periods from that 63.3% to 65.4%. And in terms of profit after tax margins, that would have also increased incrementally over consecutive periods from 43.9% in 2017 to its current level of 45.8%. What does that mean? Very simply, it means for every dollar of revenue being generated by WCO, they are able to convert more and more of it into profit for shareholders. So certainly a positive trend there, notwithstanding the fairly lackluster economic environment that they are operating in. So at a price of $33.39, WCO is trading at a price to earnings ratio of 21 times, which is above the sector average of 18.4 times. However, they offer a quite generous dividend yield in the context of the current environment of 3.9% compared to that 1.1% of the sector average. So with fair to slightly above average valuations, the relatively strong pricing power that they hold, which should be able to mitigate some of the effects of those increased excise duties and customs duties and its impact on pricing to consumers of tobacco products, and having consideration for potential headwinds to revenue growth, as just mentioned, Bourse maintains its neutral rating on WCO. Turning quickly to TCL, and for the 9-month period ended 2020, the group generated an earnings per share figure of 5 cents, which was a very nice turnaround from the loss per share of 3 cents recorded in the prior comparable period of 2019. Revenues, as mentioned, did have some marginal decline from $1.28 billion to $1.258 billion, or 1.8% decline. But again, within the context of everything that's happened in the first 9 months of 2020, that is quite a commendable performance. Now, gross profits declined just marginally by 0.1% from 395.6 to 395 million. So we'll call that fairly stable, which is again a very commendable performance. And other expenses declined sharply by 72% from 49 to 18.7 million. Overall, net income attributable to shareholders increased significantly to just $20 million for the 9 months of 2020 compared to a loss for shareholders of $11.6 million in the prior comparable period. When we take a closer look at revenues by segment, we can see that it's been 2 consecutive periods of decline in revenues. However, it is fairly stable within the context of the operating environment. Revenues from cement production and sales would have fallen from a peak of $1.229 billion in the 9 months of 2018 to $1.208 billion in the 9 months of 2020. And again, very marginal declines in its concrete segment as well, from $51 million in the 9 months of 2019 to $46 million in revenues for 2020. Now, the big story for TCL has been the turnaround in operating and profit before tax margins. And as we can see, for that 9-month period of 2020, operating margins have increased to its highest in the last 5 comparable periods, around 16.4%, and profit before tax margins have also increased quite considerably to just around 8.8%, again, the highest in the last 5 comparable periods. So certainly a very positive turnaround in terms of operating trends, again, notwithstanding the very tenuous environment that manufacturing sector stocks, such as WCO and in this case TCL, are operating in. So on the basis of improving margins, relatively high valuations, because at a price of $2.10, TCL is trading at a price earnings ratio of close to 37 times, which is well above the sector average of 18.4 times. And on the basis of inconsistent dividend payments, there have been just about 2 dividend payments in the past 10 years, if I'm not mistaken. Bourse is going to upgrade TCL's rating from a sell to a neutral. Well, that's it for this week's edition. For more information, give us a call at 2-BORSE or 226-8773. Check out our website at borseinvestment.com for all of our research and analysis, absolutely free. And you can, of course, email us at invest@borsefinancial.com. And, of course, check out today's business section of The Guardian for this article for more information that you can read at your leisure. Again, have yourselves a wonderful investing week. This has been the Bourse Report.